recording, please. Okay. Hello, everyone. Thank you for joining. And can everyone see my screen?
Yes.
Okay. Now, do you see it maximized?
Yes.
So thanks for joining, everyone. Today, we're going to talk a bit about startup finance. Everybody's hearing me clearly, right? Yes?
Yes.
Yes, we can hear you clearly, sir.
Okay, great. So we're going to talk about startup finance today. So we're going to cover a few things. So who I am and why it's important to talk about startup finance. A concept I call the founder premium. We're going to talk about valuations generally, and we're going to talk about safe notes, which are an investment tool, and why you should care about them and how they work roughly. But as a disclaimer, if you haven't done the sprint 3 and 4 on AUBX, where we cover some basic business stuff and some basic accounting, uh, you will understand this webinar more, and you can see the recording after if you do sprint 3 and sprint 4. And I would recommend also some basic course on accounting. If you can go to YouTube, just say accounting crash course in 1 hour, you'll find different videos. So it's important to understand basic accounting too, as a second disclaimer for the webinar. And finally, for people who know what safes are, which is explained in Sprint 4 on the AUBX, in this situation, when I talk about safes, I'm talking about post-money safes as opposed to pre-money. It's just some technicalities. So to start, I want to introduce myself, who I am, and why you should care about what I'm going to say. So I did an MBA at AUB with a focus on entrepreneurship, finance, and strategy. So finance has, specifically startup finance, has been something I've been looking at very closely for a long time now. I've been the PM at iPark for 4.5 years, so I've had a lot of experience with these kinds of things. And I actually attempted to raise a VC fund before I joined iPark. Didn't really work, but I actually was in the process of doing it. And I was, at the time, when I wanted to do this, I was mentored by a professor at AUB who himself is a venture capitalist, or was. And he actually he ran a $50 million private equity fund at some point in the late 90s, and he was mentoring me on this. Other than that, we've had lots of VCs come into iPark as mentors. So I became friends with a lot of them and talked a lot about this kind of stuff with them and got their opinion on different things. And I actually worked at a VC for a year as a fellow with a San Francisco, Silicon Valley-based venture capital fund called Transform VC. That was really interesting. And I am an alumni of the VC Unlocked program by 500 Global. That is one of the biggest venture capital companies in the world. So that's more or less where I got the experience from to be able to develop these modules I'm going to show with you today. We're going to talk about something I call it the founder premium. By premium, I just say what I mean by premium, like the added price you get because of being a good founder, the added price you get on your deals. So that's what they call by premium. By the way, has questions. I can't see the chat. Please raise your hand, and Maria will stop me and will let you ask me the question. So we're going to be taking questions throughout the session. And we're actually, to give more suspense, we're going to end the webinar with one of the startups in the IVP, and he's with us. Let's give it a surprise who it is. He's with us here. He's going to tell you about how he did a safe note. So remember, we talked about safe notes, why care about safes. One of the startups in the audience today, they raised the safe, and we're going to end the webinar with an intervention from him to talk about his experience with raising the safe. So that will practical outcome to the webinar. So I'm really looking forward to his part of the presentation. We can move past this. So the founder premium, it can be exemplified very clearly by this. SpaceX buys XAI in $1.25 trillion deal to unite his empire. So this is Elon Musk. I hope everybody knows who this is. He one of his companies bought another of his companies, and the private valuation for that was over $1 trillion. And they're saying it's the most expensive private valuation ever done before. And another comment in the article was like, none of the valuations are based on any rational multiple, and they're all trading off Elon. They're all putting their money there because Elon Musk is Elon Musk. Not saying people in the participants today should become Elon Musk tomorrow, but Elon Musk started with PayPal. They sold PayPal for maybe 80 million, and then he put all the money back into SpaceX. So he didn't become Elon Musk from his first startup, right? And what I'm trying to say is that the more you build, the more you're going to have this founder premium where it's not going to be a scientific lab based valuation exercise, especially if it's a private company. So the interesting thing is there's money to be made the better of a founder you are. Just like if you're a great athlete, people pay you more to play on the team. Look at yourself as a professional athlete, and you have a premium on your head based on how good of a founder you are. And we're going to get into a bit more details about what I think affects the founder premium. So, founder premium is real, and it is based mainly on perception. So, perception is one of the key drivers of founder premium. So what impacts founder premium? I'd like to take, let's say, 2 interventions from the participants in this webinar. Can anybody in the audience, I want just 2 interventions. So can somebody from the participants tell me what might impact a founder premium? No need to raise your hand. You can just have an intervention.
Are we talking positively or negatively impact? Because it can go both ways.
Well, we're going to talk about when it goes negatively later. So it's a good point. So give me both examples. Give me both examples. Good and bad.
I'd say good. What could impact the founders? It would be their personality, how they are.
Sure. Yeah.
I remember, for example, one time, even though it's speaking of Elon Musk, I think he was on Joe Rogan and he smoked some weed, and that really impacted their stocks on the spot. Just to show how the more
in a positive way.
At the time, it was in a negative way. But the concept of it that the more important or the more famous the more influential I'd say the founder is, and the more the media is following them on the spot, the more important is how the general views them.
Right. But you said something about it being negative. Well, what's your example there?
انه مثلا any scandal, any how their work is, or they do a lot of shady deals,
right?
How they
right.
treat
So
how
we're
they might treat their
that.
employees.
It's a good point you're making, because later we're gonna we're gonna see some case studies about valuation, and then we're gonna talk about one negative way, like I called it, when the founder premium goes wrong, basically. So when you have all of this leverage and you have all of this personality and you have all of this influence and you use it in an unethical way, right?
Yes.
So let's go into some things that impact the founder premium. Definitely how presentable you are, but you have to be careful about something, because if you're in Silicon Valley and you're dressed like an investment banker, like tie and suit, they don't like it. But if you're in New York and you're wearing flip-flops, they don't like it. So it depends on where you are, and you want to be presentable for the area you are at. I mean, generally you have to be presentable, generally speaking, but don't think that dressing up like a banker in Silicon Valley is going to be the way, or dressing like a Silicon Valley person in New York is going to be the way. So definitely this is one important thing. Definitely how well you understand your industry, and that goes back to numbers. So you want to understand the numbers of your industry. Talk about how you understand your solution and why your solution works and why others can't do it. And all of this is conversational. It's not like I'm not talking about showing a pitch deck. Talking about when you're talking to your investor, to your stakeholder, to your potential board member, you want to explain these things very fast, very clearly, very clean. How well you speak. Are you monotonous? Do you hem and haw? Are you not sure what you want to say when you want to say it? You have an interesting voice. Are you animated when you talk? How you react to negative or constructive feedback. So this is interesting because there's two opinions on this. Because there is one school of thought about, and this is the majority of people, they think being coachable is a good thing. And I think most people in the participants would think about that in this direction. But there's a venture capital company called A16Z who have a general partner called Mark Andreessen. They actually look for founders who are not coachable because they want to see a founder that is a kind of arrogant and that knows their solution to the point where if somebody wants to give them a critique on it, they get defensive and they start to think things like, what do you know about my solution? What are you even telling me about what I do? I know best. So this is a debate. I think people would think coachability is a good thing, but keep in mind, there's some people who think that being coachable is not something they look for in a founder. So keep that in mind. How much of us? This is a tricky one. I mean, if these investors, they figure out you're working 8 a.m. to 8 p.m., 6 days a week, you take no breaks, you're always on it, on it, on it. This reflects positively, generally speaking, unless you burn out, right? So this isn't a recipe. I'm not saying go do 8 a.m., 8 p.m., 6 days a week. I'm not saying you have to have perfect on all of these factors. If you have a few factors, great, then that's very good from the start. But like Elon Musk, for example, the dude works 16-hour days. So 8 a.m. to 12 a.m., I think, if I did the math right. So anyway, more factors. How fast you reply to emails. This one is big. So whenever I get an email from a potential investor for iPark, if I see the email, I respond very fast. Like I respond within minutes. And it's sometimes even to the point where they expect like to do PowerPoint slides and the meetings, like if we set up a meeting for tomorrow about a particular topic, they expect to get PowerPoint slides done by the next day, talk about your topic on the slides. So this is one is maybe overlooked, but something this fast, this small, like how fast you respond, how attentive you are, it reflects positively with more senior people who don't like wasting time. Other than that, how optimistic you are. There's a concept called perpetual optimism. So you're always optimistic. Whatever happens, you're still thinking big, you're still thinking positively, you're still thinking how to make the best of a bad situation. Micro signals, so body language. These are things that are very difficult to quantify. These are things that somebody just picks up unconsciously, but they factor out how people start to think about you. Intelligence, obviously, we have to mention this. This is an obvious one. How good of a leader you are, and your people skills also very important. And one of the participants came in and he said your personality. So I guess with your EQ, when you're making a deal with someone, it might come down to like, okay, we want to make this work. And when you say we want to make this work, it just means that we're going to try to build redo the contract in one way or another. And because we feel it's a good professional relationship, we want to make it work. So we will work on the legal stuff because we like each other and we think we can work well with each other. The legal stuff isn't perfect yet, but we work on the legal and we push for the legal to be changed and modified so that we can work together because we see there is a good synergy between us. So this is very important too. And I want to say many of these factors indicate your level of self-confidence. So I would say being self-confident and portraying self-confidence to potential investors as a startup founder is very important. Ultimately, this is like a good triangle. So you have your network, obviously. who you know, what kinds of introductions you can make. You know somebody at a VC, can they introduce you to a VC? Do you know people who can sponsor you to go travel to a startup conference, who you can meet there? University graduated is important. You're at AUB, so you already have a very good benchmark for people who want to look at you as a founder if you're from AUB. So you have all the GCC, even North America, know AUB very well. Even in Europe, one time I was in Germany and we were talking to one lady there. And when she found out I was in AUB, she was like, oh my God, really? So it's very well known around the world. So you have that. Past experience is also very important, but I would say more particularly, do you have previous startup experience? So it's fine if you don't, doesn't mean it's not going to work. But let's say you have your first startup and then you sell it for $10 million. The next time you already did a lot of the legwork, right? You already had to reach out to angel investors, to VCs, you did investor memos, you did PowerPoints, you traveled, you got customers, you burned out 3-4 times, and then you sold your company. Phase two with your next company, with that experience behind you, it's so much easier to talk to the investors. They already know you're going to make the money because you did well. Well, they can't really know, but they're going to have confidence in you because you already have a startup under your belt. So if you don't have that, it's fine. But think of it more as a long-term thing, entrepreneurship. Don't think that if I don't make a killing on this company, that it's over. It's not. It's a very important concept. So, and we come to the point that we have a course about this for iPark and the UBX. It's personal development never ends. So all of the above, you can work on it. And you might reach your peak by the time you're 50. You might reach your peak at 55, at 60. It might be at 40. It might be at 35. People peak sometimes in their mid-20s. So different people peak at different times. But even after you peak, you will still be able to improve in different directions. So really, personal development never ends. So we finished on the founder premium. Does anybody have a question before we move on to valuation?
Yes, regarding, if I may ask,
Yeah, sure.
regarding the email part, how
Yeah.
would you recommend that people who genuinely speaking are, because startups in general on their own are very busy when you're building, and even harder when you have a second job that you
Yeah.
use to sustain yourself while building something.
Yeah.
How would you recommend for someone to handle responding to emails so quickly? Because sometimes without noticing, you can miss an email, especially.
Yeah.
It's part of your almost everyone's daily jobs, be it a student, be it a doctor, be it an
Yeah.
engineer, anything.
Yeah. I mean, look, it's two situations you might face. Either you have talked to somebody and you're expecting them to reach out, or you're expecting an email from someone, or you're not expecting. If you have reached out to a senior stakeholder, investor, advisor, mentor, and you're waiting, I mean, you're expecting a response, I would keep an eye on it. Put some mind share on it. The tricky part isn't when you're not expecting it and it comes and you're late. I mean, if you're not full time on your email because you have other things to do, it's going to be practically impossible to guarantee you're going to get these unexpected emails. So this is when you start to think. I mean, you don't want to, but you don't want to end up losing you don't want to lose a relationship because you were too late. I would do something at this early stage. At least don't check all your startup emails, but leave time, let's say every day at 6 p.m., just scan your inbox. Just scan it very fast. Don't go into everyone. Did you get an email from someone you don't know if with an interesting subject about, I found your startup through iPark? If you see a subject like that at your 6 p.m. checkup, so set time, set 10, 15 minutes at 6 p.m. every day to check your inbox. So I would do that.
All right, thank you.
Okay. Now we're going to move on to valuation. It's a very tricky concept. It's just a fancy way of saying price. It's not really price, though. So when you look at the water bottle, you say it's how much does it cost or what's the price. So valuation is just a fancy way of saying price, but when you're talking about companies, I don't know why they call it valuation. They could just call it price. So, but the tricky thing is that price and value have different definitions in finance. This is why it's tricky. So, if you want to think about it, think about how much money is this thing worth, basically. But that's not all the entire picture. But I said, what is valuation? But now I want to take an intervention. Somebody from the participants, I want you to tell me what is risk and what is the relationship between valuation and risk. Does anybody know? Does anybody know the relationship between valuation and risk? I'll take that as a no. Okay, so basically, they're inversely related. They're 1/x. They're not positively correlated. They're negatively correlated. So whenever there's more, let's say about the risk. We're going to talk a bit now about risk. I would just say that risk is theoretically the probability that things might go negatively for you. That's how you can think of risk, generally speaking. The more there's a probability that things are going to go wrong, the lower is going to be the price of your company. Okay. And there are many different types of risk. And we're going to talk about a big one right now. But you have to understand the value of a company is inversely related to the amount of risk around it. And risk is an extremely central topic in finance and accounting, extremely central, as is valuation. So valuation and risk are things you can find if you want to deep dive in some corporate finance book and some accounting book, but understand that they're inversely related. So now we're going to talk about a particular example of risk, and you're going to see what I mean. But before we go there, I want to talk about a bit valuation. The easiest way to think about valuation is to think about price per share. Okay. So price per share is like, I'm sure a lot of people in the participants know about the stock market, right? So in the stock market, it's you see a share price on your screen. The Google has a share price of $300 a share. With startups and private markets, you don't have that. It's a private company, so you can't go to a website and see what the price of a SpaceX share is going to be. It's not going to be something that's traded that liquidly. But when you think about the valuation, it's useful to think about price per share, which is just really valuation divided by capitalization. Capitalization, you can think about it simply as number of shares. There's more things that go into it, but capitalization alone is its own webinar. But when you think about valuation of a company, always try to think about the price of each share. Okay. And I want to talk a bit about the factors that increase risk. And something that all of us are going through right now is geopolitical instability. Okay. The more there is risk, the lower the price per share. Okay. The more geopolitical is a macro risk. So there's macro and micro risk, but this is a huge macro risk. And it affects all the startups that want to come out of the country. It lower their valuations, which is why we at iPark are backing and recommending the foot in, foot out strategy. As in, if you're a United States company and you're going to the United States, you might get a valuation of $5 million. But if you're in Lebanon, you get a valuation of $1 million. This is real. Like, we're getting this. These results are coming directly from companies we're talking to who are incubated with us. When they're promoting themselves as being USA companies, their valuation in the eyes of the investors is much higher than when they're promoting themselves as Lebanese companies. So this is why we at iPark are a startup incubator that's going to start you here locally, and we send you to programs in Europe, to programs in GCC, to programs in the United States. So this is why we have a hybrid model of not just focusing on the Lebanese economy, but because we understand the risk situation, we also highly recommend that people get their foot in outside of the country as well. So I want to just talk very fast because this is a term you're going to see a lot when you're doing anything that has to do with startups. Valuation cap, okay? Valuation cap is not the valuation. They're two separate things. Valuation caps appear in convertible bonds, safe notes, and KISS notes. We're going to focus today, later in the webinar, on safe notes, okay? Convertible bonds are more debt-oriented. So in accounting, you have debt and equity. I would say convertible bonds are more debt. Safe and KISS notes, they have elements of debt, but aren't really debt. I go deeply into this on the AUBX course on Sprint 4. But the cap appears in these instruments. In the contracts that you end up doing with investors, caps appear as clauses inside of these agreements that you make. Okay, and the way caps work, it's not that different from how evaluation works, but I'm going to explain to you why they're fundamentally not the same thing. It's just something you have to keep in mind. But before that, just generally speaking, the scientific valuation techniques that people who go to business school learn, they don't apply to early stage startups. The ones I'm talking about are like the VC method, discounted cash flow valuation, comparable company analysis, or precedent transaction analysis. We're not going to go into these, but these are more, I would call them scientific, numerical methods to actually come to a proper valuation. You can't do that without significant data. You need some data to be able to do a proper valuation. So these techniques don't apply to startups. But to understand that the valuation cap that you end up having for your company, because you can't do a proper valuation, in the sense that if you do a proper valuation to a startup with pre-revenue and pre-users, the valuation is going to be like $10. And that is really, really hurts your company to have that low of a formal valuation. So the concept of valuation cap, you can think about it, it's a protective provision that can set you up with something like a valuation, but that's based more on your potential. For people who know a bit more, something in the stock market called the PE ratio, which is price to earnings. Price here is something of a forecast of how well the company can do versus its earnings on what kind of profit it did today. It's similar with caps. Caps aren't valuing your company right now. Caps are bet that this company has potential. Think about the cap as your potential worth versus what you are actually worth right now. And really, like, to really put this home, because when you get into, if you're interested and you get into the calculations of how a valuation cap actually works, I've talked about this online, and I can share some resources. You might get confused because with valuation cap, they're saying they're going to put in $1 million for a $10 million valuation cap. And then that means 1 million over 10 million, it's 10%. So they took 10% of the company. It sounds identically to a valuation. That's how valuations work technically. You're putting in money at the valuation and you get a percent. So in that sense, a valuation cap posts money, and a valuation, they behave in a very similar way. But fundamentally, they're completely different, because when you get a proper valuation, the investor is giving you money and you're giving them shares. With a valuation cap safe note, there's no shares issued. You only get the money. You don't give them any shares. And as a founder, your most important asset are your shares. Your shares are gold. And you want to give up as little shares as possible, because that's where the value is going to be when you become a huge company. It's going to be in your shares. So if you can get the option of getting money without giving away your shares, why wouldn't you do it? You're just getting money. And that's how safe agreements work. With a safe note, you're getting money, but you're not giving shares. That's why they call them simple agreement for future equity. So in the future, the other party gets their shares, versus right now with a valuation, you're giving your shares out immediately, which is not where you want to be very early on, especially that your valuation is going to be very low and you're going to sell your shares at a very low price. So this is how caps or capped safes versus valuation. This is the really fundamental difference. And I really, really, really urge you to think about this deeply, because it'll save you a lot of headache whenever you want to try to explain these things to anyone. And we want to talk a bit about a spectrum for what to expect, like what's a good valuation cap versus a bad valuation cap, what's high and what's low. But it's difficult to create a comprehensive cap spectrum because caps differ by geography, traction, so what progress you've made, your revenue, your user growth, your user retention, your step up in valuation, any pre-existing investments, that makes a big deal with caps. So with iPark, we have a standard safe note that we share. But if you came in with a higher cap than what we offer, we match the cap. So this is very important. If you have pre-existing investments, it gives you more leverage to negotiate. And the founder premium, obviously. So you cannot just create a one-size-fits-all cap spectrum, but for a spectrum for pre-revenue, pre-investment startups in high-risk markets, high risk like Lebanon, for instance. And I say roughly, these are not exact, but this is roughly what it looks like. So if you're going to have a cap of $100,000, you might as well not raise the money because it's so low and it hurts your company later on. But I'd say around 2 million would be going on the high side. And we're going to, at the end of the webinar, the startup that's going to talk about their safe, they actually got a higher cap than this. But I wouldn't say 2 million is the max. But when you're getting around 2 million, it's a bit higher. We offer around 1.4, 1.5. So we're on the high end. So go get higher caps, I would say. But that's the thing. I want to come back to the founder premium. You can't negotiate it. You can't come to an investor and tell them, well, I have a founder premium, so I want the higher cap. No, no. So the founder premium is more like what the investor picks up from you subconsciously and they start to increase the price in their head. That's how the founder premium works. It's not a rational negotiation term. Like cash flow, for example, is like, okay, well, I made this cash flow positive. That's undeniable. Nobody can say anything about that unless you somehow got the cash flow unethically. And disclaimer, these numbers, that low 100K, high 2 million, the numbers will be completely different in Silicon Valley where valuations are probably the highest. This is why, again, we recommend foot in, foot out. The valuations in Silicon Valley are going to be higher than this. So do not think that the numbers I just gave you are a one size fits all for everywhere. They're bigger in Silicon Valley, no doubt about this, because the risk is lower. The risk is lower, ease of doing business is higher, people want to spend their money more easily, people are more motivated to back risky companies. So you can call them risky companies, right? But a startup in Silicon Valley is less risky than a startup in Lebanon. So this is coming back to the concept of risk. Probability of failure is risk, technically. And we talked a lot about like caps and valuations and like who cares, right? But there's a practical element that you should care about and that you will use in your strategic thinking. Think of caps and valuations in terms of dilution. For people who don't know the concept of dilution, just means, let's say we have 100 shares, okay? Think of it as a pie. Let's say me and Maria, each of us own 50% of the company. So I own 50 shares and Maria owns 50 shares. We have the full pie. Now, when new investors come in, they could buy my shares. Then they would have my 50 and Maria would keep her 50. And now I have 0, right? In that case, it's called a secondary sale. I sold my shares and somebody bought my shares directly. But the primary sale, that's not what happens. The primary sale, we issue new shares to a new investor. So I don't sell my shares. Maria doesn't sell her shares. The company issues new shares. So if initially I had 50 and Maria had 50 and somebody else got 50, we're giving up 1/3 of the company. So I no longer have half of it. Now I have 50 over 150. This is dilution. When the percentage ownership of the company goes down based on issuing new shares to new investors. This is the concept of dilution. And you have to think at the point of reaching Series A, which might take you 3 to 5 years, you would still need, if you're a software tech startup specifically, keep around 40-50% of ownership at that point. So you have, every time you want to raise, you have to think about how much am I giving up? I want to have 40% by the time I reach Series A, after the Series A investment, obviously. So think about, plan your dilution strategy. This is central to startup thinking. Every time you want to raise money, you need to forecast to the future. I want to keep 40% by Series after Series A, because then your investors will still see I have skin in the game. They will be, no, I'm still motivated. I'm still on fire. I'm still working very hard. If you have 5% of the company, then you might even get demotivated, feeling you no longer own anything. You're no longer even the major shareholder, and then you might feel like you've been disowned by your company, or you've disowned your company. So plan carefully your dilution strategy. And when we come to a case study we're going to talk about later, I'm going to show you one of our startups, how they did their dilution in their early stage. And you're going to see a very important point about having a technical co-founder or being technical yourself, and how that could save you a significant amount of equity dilution. Okay, now we're going to talk a bit about quickly the valuation techniques for early stage. One thing is called the fixed range method. This is most widely used for very early stage companies like yourselves. And it's very popular with accelerators like Y Combinator do it. If you don't know YC, please Google them. A16Z are a VC fund. A16Z are a VC fund. They have a speedrun accelerator. They also do it. We do it. And I'm saying no room to negotiate. Like, it's a fixed investment with a fixed cap, but it's not that cutthroat. Usually, if you don't have a pre-existing investment, then yes, there's no room to negotiate. But if you have a higher cap, then we match it. So it's not the one-size-fits-all thing. It's a case by case. Now, there's another interesting technique for very early stage, but this one is a bit later because it's called the scorecard method. And this only works when you reach a stage that you can find reporting on the pre-money valuation of startups similar to yours. So when you can actually go online on Magnet or on Google or Crunchbase, even if you can on PitchBook, if you have a subscription, that's where you try to find pre-money valuation of startups similar to yours. If you can't find that, you cannot do this method. So this is just for a bit later on when you have more traction and you can find data on similar startups. It's at this, and it's difficult to be objective with, and you're going to see why. Now you'll see why shortly. You need to compare against the average. You need to compare against other companies who are similar to yours. And you need to do it with more than one benchmark. So preferably two, 3, or 4 startups who are in the same demographic region, same target sector, and you compare yourself to them in the following way. How it works. So you find a pre-money valuation of a similar company in the same market, industry, and stage. Choose comparison areas. We're going to look at what these look like. You set a weight for each comparison area. You input a factor against the average comparable company on each comparison area, one being average. Don't worry, we're going to see a slide about in a table how that would look like. Then you multiply the weights by the factors and you sum them, making a total. Then you multiply the pre-money valuation that you found in the market by the total percent. So it looks something like this. For comparison area, you have management team, total addressable market, product, competition, marketing, and sales. So you put a weight on each one of them. The weights add up to 100. And then you say, well, you know what? I think my management team is better than the average. So it's 1.25. I think my total addressable market is the same as average. It's going to be 1. My competition, they're a bit more competitive in the industry than I am. So I have a less than 1, it's 0.75, etc. So then you do the weight times the factor times 100, and you come out with a total percent. It's 112. What you do, you take that number and you multiply the average post-money valuation, pre-money valuation by it, sorry. So you take the 10 million and you multiply by the percentage on the right-hand side on the lower row, 112.75, and you end up with a higher valuation than the average. So the reason this is difficult to be objective with is, like, if you're very confident, which is a good thing, You don't want to be overconfident. You might think that you're much better than the average by a lot. And then you would say you're much more valued than the average. So this is why it's difficult to be objective. So you need to have good arguments when you come to. Okay, so now we're gonna see very interesting case studies. But before that, does anybody have any questions on valuation?
Can I ask?
Sure.
So when it comes, Kermel, the share dilution part.
Yeah.
Maybe I missed it. Maybe it's a naive question, but would you recommend there's a specific number when it comes to share percentages of when we're diluting the shares?
Yeah. Me. So you see on this slide, iPark startup case. You see that on the fourth bullet point.
Sorry. Yes, case studies. Yes, I can see the case studies. Yes.
Yeah, iPark startup case. I'm gonna show you how one of our startups diluted, and I'm gonna give you like benchmarks. He did pretty well with it. So
all right.
But if you want, generally speaking, by the time you get to Series A, the venture capital company is going to want to take 20 to 25%. This is the standard. Earlier stages, you have less leverage. So even like, for example, your dilution is going to go down the more leverage you get. So the better the company is, the less you would need to dilute. I would say for very early stage, your seed round, 20% would be like, I don't want to say pushing it, but you can do it because you might need to do more than one seed round. I wouldn't say that more than 20-25% on a single round is good. So this is kind of like a limit that you want to put in your head. 20-25% is a lot, is what I'm trying to say. So if you want to, let's say, carve out something for advisory, you can say, okay, I'm going to keep 5% for advisory, 10% for stock options, and then I'm going to raise a seed round and give out 25%. So seed round is 25, and then you have the stock option pool is 10%. That's 35. Your advisory shares 5%. You have 40. At Series A, you give up another 20. After Series A, you still have 40%. You're in a good spot. That's how you want to think about it. But like these are negotiated. The lower you give up equity or the better a cap you can put to keep a good percentage of dilution, the better. So try to pull it back as much as you can. These are just benchmarks. When you negotiate, if you can convince and you can sell, you'll have a much better time keeping your dilution low. It's a negotiation thing. It's a negotiable entity, dilution, really.
All right, thank you.
Okay. So we're going to talk about some case studies to kind of put things into perspective. Yella, first, we'll start with Yella. So Yella, actually, my friend was a co-founder in this company, and they raised $2.2 million from Justin Mateen, who was the co-founder of Tinder. So Yella was very interesting, and I was talking to him very closely. My friend, who's the co-founder, was the co-founder because the company closed. We're talking to him very closely at the time. I was just new with iPark, and it was very interesting to see his story and what he was doing. I actually called him recently to see if I could share this information. So they raised $2.2 million at a $7.5 million valuation. So they gave up actually 33% on this round alone, which is really high. And they did it straight equity, not even with a safe. Okay, and we're going to talk about why do a safe not straight equity later on. I have a slide about that. But I want you to understand like what happens on the ground in real life. Theoretically, you can't predict it always. Okay, and Yella, we talk about validation and customers and traction. They had a pitch deck. They had only a pitch deck. They had nothing else. They had a pitch deck, and they had Amro Diab and Haifa Wahba and other famous people who want to be onboarded on the app. The app, what it does, it's like Cameo. So you can get a famous person to send a video message to maybe a loved one on their birthday, singing happy birthday. So they had these celebrities. They knew them. This is their network, right? We talk about founder premium. So they knew these famous people. And based off a pitch deck with no revenue, they were able to raise $2.2 million, okay, with a pitch deck. But they closed down because they didn't do all this validation earlier. They failed due to a pricing problem because their main target initial market was Egypt. And they couldn't find a price point that would be sustainable for the company that would make sense to people in Egypt, because the people in Egypt weren't going to pay big money for these kinds of videos from the celebrities. So this is what we call the riskiest assumption. Would the people in our target market pay for our offering to make it an interesting proposition for us as a business? Well, it turned out this assumption was wrong. They got the money first, and then they figured out they were building the company on incorrect maxims or incorrect assumptions, and it closed down. And they didn't get any revenue, I think, or maybe limited revenue, but it closed down for sure. So think about this. Think about this. There's another situation with a friend of mine who was an employee at a startup in the UK, but this one I can't mention names. They raised the founder, he raised 2 or 3 million British pounds, which is more than $2 to $3 million, just off a business proposal. He went with a business proposal and he was able to raise this money. Why? How? Because he had a strong network in technology and finance. He worked at huge finance and tech companies. So people knew him, they trusted him, and they gave him the money. And the company kind of, I think it shut down too, or it's shutting down, because it's not easy, like what they're trying to do. And the valuation is undisclosed. So this is something also I would recommend people and the participants don't disclose your valuation unless you need to, man. It's a private thing, okay? So it's not like you're gonna be left and right telling people. Some people brag about it, like, oh well, I raised $1 million, my valuation is 10 million, and they brag about the $10 million valuation when it means nothing. Sometimes companies don't like to disclose, so this is a thing too. You don't need to disclose it. If you want to brag about it, go ahead. But sometimes it's an undisclosed amount, okay? So just keep that in mind. This is another one. This is a very interesting case study. So it's called Fast. They're fast checkout. So with Amazon, you have to buy get the book, add to cart, go to address, go to credit card, and then you can buy the thing from Amazon. Fast is a company that made it very fast to check out, and it shut down. And we're going to talk about that. So by the time they closed, and this is the source is NPR, by the time they had closed the company, they'd raised $120 million. They had a Series B of $102 million in a round led by Stripe, the payment processor. And on their next round, after the Series B, they targeted above $1 billion valuation with only $600,000 in revenue the prior year. They were targeting $1 billion valuation round with only $600,000 in revenue the prior year. Think about this. Think about these numbers. Now, the KPI wasn't revenue. What was the KPI? The number of merchants signed and the growth rate of how many merchants they kept on onboarding. Now, they onboarded enough merchants to raise a Series B of over 100 million. But really, how long can it last? How long can it last? You do not get money from unpaid merchants. You have more users, you have more sellers for using it, but you're not making money from it. How long can it last? That's a question. Ask yourself. Do you not have a sustainable business model? How long can you keep raising bigger and bigger amounts to the point where at some point you're just like, it's just not working? And you put your hands up in the air and you're like, well, we're going to have to close up the company. Now, iPark startup case. So they have actually a pre-seed round, and they split it into 3 parts. They had a pre-seed round at a 1.5 million cap, where iPark participated in this round. They raised $100,000 at the 1.5 million cap, so they diluted 6.7%. Then they also had a tech for equity deal where they diluted. It's a $500,000 deal at 2.5 million cap. It's a 20% dilution. And now their next round, the third part, I'm sorry, is $1 million raise at an $8 million cap. So they're giving up 12.5%. So how much does it come up? So 20 and 12.5, 32.5 plus 7. Let's say 40% they've diluted. And they had to dilute 20% because they couldn't build the technology because there's no technical co-founder. So imagine if you have a technical co-founder that can build the thing, or if you can build it yourself, for this kind of case study, you're saving yourself 20% dilution, which is huge. It's huge to be able to save that much. Because then if you want to raise another seed round, you can still give up 20% if you're not ready for Series A, for example, with your KPIs. So now this is also interesting. And this is a company called Revo. Look at that. Revo has raised 80 million from investors. You should know these VCs, Hustler Ventures and Kleiner Perkins. They're VCs from Silicon Valley. So 80 million raise, bringing the startup's valuation to 500 million. And we're going to see the story of Revo. Mona Ahmad, who is an AUB alumna, works in product in Revo. They were in stealth mode. Stealth mode is a concept in startups where you're under the radar, you haven't disclosed your brand, you haven't disclosed your name, you haven't told anybody what you do, you're in stealth. So they came out of stealth and announced that they'd had initially raised in stealth a $10 million seed, and they had a $70 million Series A. This was their announcement. They literally announced, we're coming out of stealth and we've raised 80 million. And there was no report of any revenue. So they raised this money based on, now you're going to see why. Founder Premium. And we're going to watch this video.
David, I would love to start with
you. Can you hear the video?
Yes.
Yes.
Okay.
Yes.
David, I would love to start with you. You're trying to tackle the concept that you have labeled the Frankenstack. Even though the term is new to me, the concept is something that's been discussed on this program a lot. Just explain what Revo wants to achieve here.
Sure. Well, first off, thanks for having me. It's a big day for us. Look, AI is the biggest shift in enterprise software since the cloud. But the reality is revenue teams are still stuck in, like you said, what we call the Frankenstack, which is a dozen different tools that don't really talk to each other, causing sellers to waste over 70% of their time wrangling software instead of talking to their customers. And that's really painful. Revo is looking to fix that via one unified revenue operating system built from the ground up with AI at its core. And with this 80 million raise, we're scaling quickly to help all companies win in the age of AI.
Vinod, I was talking with my team this morning about the structure of this round. And so it's basically a combined seed and Series A. And Revo is coming out and kind of announcing itself to the world. Would you kind of give us the backstory? You know, you are an experienced investor in the world of technology. When this crossed your desk, how did you know that you needed to get involved? And how did you determine at this very early stage the potential that Revo had?
The opportunity didn't actually cross our desk in a traditional way. We've known David for a long time, from DoorDash to OpenDoor to OpenStore, and now Revo. We've been incubating ventures with him. My partner Samir has worked closely with him on Revo. And we cooked up the concept, brainstormed it, and thought it was important enough to do. In the age of AI, I think most applications and application stacks need to be rethought. And this is David, just a superstar entrepreneur. So it was pretty easy.
Equity indices built on opinions? That's the old way. The new way is blue.
Vinod, is this an example of you investing in the known quantity founder then, rather than the idea?
Absolutely. When we invested, the idea wasn't clear. That was a year and a half or 2 years ago, but the founder was very clear.
Okay. So, can everybody hear me?
Yes.
Yes, we can hear you.
Great. So, the investor, Vino Khosla, said, when we invested, the idea wasn't clear. Imagine you're going to an investor with an idea that's not clear, and they give you $10 million. But the founder was very clear, and he was happy to back a superstar entrepreneur. So in startups like Founder Premium, I cannot stress this enough. Okay. Now, back to our initial point. Earlier in the webinar, one of our talented founders pointed something out, that the founder premium can go wrong, right? Right. Does anybody know who this is?
What's her name?
Yeah, what's her name? What's her name?
I know what she did, but I forgot the name.
Okay, does anybody know? Okay, so her name is Elizabeth Holmes, and she was the founder of Theranos. Basically, Theranos was saying, you know how when you go to the hospital and you need to get a blood test, they plunge in the syringe into your vein and they have to fill a whole vial with your blood to put into the test machine so they can test whether or not you have LDL, HDL, whether you have any kind of disease. So her innovation was from a prick, from a single prick, one tiny drop of blood, they can run like 70 tests or some big number. This was her proposition. Theranos was, not is, was, right? Read this. Founded in 2003, Theranos raised more than 700 million from VCs and private investors, resulting in a $9 billion valuation at its peak. This is pre-revenue, by the way, for revenue. So this is at their peak. They were valued at 9 billion. Then the following year, accusations of fraud began to surface, and Forbes revised its estimate of 9 billion, and the net worth is now zero in 1 year. Not based on anything, guys. It's based on the founder and what the founder can sell. So this is the dark side of the founder premium. I hope everybody here is super ethical, because it's a lot of power when you have charisma and sales skills. So be careful. They called her one of the world's 19 most disappointing leaders. And there's actually a very good television series about her story on Disney Plus. I recommend everybody watch it. I was watching it over the past few days again. I watched it back in the day, and then now I watched it again. I would really recommend to watch this series. It's one season. I think it's 8 or 10 episodes. Each episode is around 40, 50 minutes. Really worth it. Really worth to see how a Silicon Valley startup looks like, how they went wrong, question their decisions, see maybe how you would have done it. It's a really good show, and I think the actress Amanda Seyfried, I think she won Best Actress at the Golden Globes or the Emmys, but she won a big award because of this show. She does a really good job at it. Now, before we get into safes, does anybody have any questions? Okay. Why care about safes? So we're not going to get into how they work technically. You can see the AUBX module sprint 4. I actually go through the mathematical calculations and how the mechanics work. But you have to understand something, especially in this region. Most people don't know about safes. They don't know how they work. They don't know what they are. And this goes to lawyers, board members, investors even, and financial consultants. I'll tell you a story. There was a startup that we wanted to invest in, iPark. We use a safe when we invest. So we were talking to the managing team, and they didn't know what a safe was. So the managing team got the financial person at the company to talk to me, and I was explaining what a safe was, and she wasn't getting it. So we set up another meeting with the company's financial consultant, and her financial consultant couldn't understand what it was. So they had to take it back to the board to see what the board thinks. And the answer we got ultimately was that they didn't want to do the investment. And I'm telling you, it's because the board didn't know what it was, and they were like, forget about it. It's not that complicated. And even lawyers, the lawyers that see the safes sometimes don't know what they are or how they work. This is why it's up to you to understand how they work, to explain it to people. Okay, this is what I'm trying to say. And I actually have, before we get into how to explain it to an investor who doesn't know what it is, I want to make a distinction between a safe and institutional equity. So be careful. This is a very key distinction. I'm talking institutional equity. I mean from companies, from investment companies like venture capital companies. I'm not talking about you giving your best friend 100 shares and getting $100. This is not institutional equity. This is like a napkin agreement. Institutional equity agreements are very expensive. They have lots of back and forth legally. They have lots of clauses, lots of provisions, lots of do's and don'ts, lots of downside protection, lots of upside gain, lots of things to disclose and things not to disclose. It's a hassle and it's expensive, and you don't want to go through that kind of thing. And this is why this is one of the reasons you go with a safe initially. Less legal overhead cost, fewer documents to draft. It's usually just one page or like one document with 8 pages, boilerplate. So it's probably the same everywhere, just tailored for the jurisdiction. Less terms to negotiate. With a safe, usually you negotiate the valuation cap and the discount. With the equity agreements from actual VCs, it's a whole host of documents and things to negotiate. And you defer, like I said before, with a safe, you defer the share purchase. With equity, they're getting the shares today. And really, the fundamental thing is like you want the money today, right now. So with a safe is the quickest time to cash hitting the bank. With institutional equity, a lot of the times what happens is with VCs, or you get a share purchase agreement, you get a term sheet. The term sheets are not binding. So let's say you negotiate with the VC and get a term sheet with them, and there are clauses in there, and they do their due diligence even deeper, and they can blow up the deal and say, well, we did more due diligence, and we're not going to invest in this company because we found unfavorable, like, what could be something unfavorable? Inflated revenue expectations, for example, from the actual data. So the quickest time to hit the cash hitting the bank is definitely with the safe. How to explain the safe to an angel investor? Simply, the investor puts money in, but shares are given in the future. It's a low-cost alternative to equity, which protects the investor from a big equity round. The value, you have to understand how to explain valuation cap and discount mechanics, which are explained thoroughly in the AUBX module in Sprint 4.
Doris raised her hand.
Sure. Okay. Let me just finish this slide and I'll take your question. So the price per share mechanics as well, it's on AUBX. And you have to explain to them that shares are issued, what we call conversion at qualified financing round. Qualified financing, but it needs a webinar on its own. But just plainly, theoretically, qualified financing is when you get the venture capital price round with a price per share set by the venture capital company. Think about it like that. It's not technically all the time this way, but if you're going to Google it, that's what it's going to say. But in reality, Google isn't always right. So shares aren't traded now. They're traded when you get to the qualified round with a VC. And safe is startup friendly because it defers issuance of shares, but it's also investor friendly because legal fees for structuring the deals are very low. It's a standard template adapted for jurisdiction with 2 terms to negotiate. And ultimately, also, the safe is investor friendly because investors get preferential treatment versus the venture capital companies who come in later. It's like a thank you to the early investors for taking more risk. If you read these and you feel that there are things that aren't that clear, please email me and we can have a call and I can walk you through these different elements because I really, really feel that you really gain a lot of credibility with investors who know this and you can talk to them about it and negotiate about it. And you're going to gain even more points with angel investors who don't know it, but to whom you explain it to and who understand it based on your explanation. I really think you should put a lot of time and effort to try to understand these things to the point where you can explain them clearly to stakeholders. I'll take Doris's question. Doris? Hello. Maria?
Yes, Doris. Yes, Doris, we cannot hear you. Unmuted.
True Maria.
She's unmuting and then muting. We cannot hear you. If you want, you can type in the box and I can read it.
Type in the chat and we'll get to it at the end. So this is like a nice little framework I came up with, but this doesn't really apply when you're still in the fixed range stage. So in your stage, that doesn't apply, but start thinking this way and you will be able to use it later on when you have more traction and KPIs. So on one axis, it's leverage, so negotiation leverage, and another axis, it's the valuation cap you want to set. So the valuation cap you're coming to investors with. You have a high negotiation leverage and a high set valuation cap from you. I would call that the jeweled startup. This is the startup that has a very good value and it's rationally or maybe irrationally set as a valuation. But if you have a high cap with no leverage, it's not favorable. The investors will not look favorably on this. They're going to feel like you're a bit inflating your value, which is not great. But now there's a case where you might have high leverage, but you're setting a low cap because you're not confident. You would have a lot of data points that indicate that you have a good amount of negotiation leverage, but because you're not very confident, you set a low cap. I've seen this happen. In this case, I would call you the undervaluer. And ultimately, if you have low leverage you set a low cap, you're more like a tech-enabled small to medium business than an actual high-growth company or a startup. And what affects leverage in the negotiation framework? Like we said, KPIs, which includes traction, revenue, pre-existing investments, your network, obviously, and of course, founder premium. Don't forget that. We're going to end this webinar with an intervention from, let's see, Bud, are you with us?
Yeah, I'm here.
Yalla, please share your screen and go ahead. We're going to end the webinar with an intervention from Fuad, who's one of the startups in our incubation program, who raised the save, and he's going to tell you how he did it and what it looked like and what he went through to get there. Fuad, please go ahead.
All right, just give me a second. I'll need to rejoin. Just give me a second, okay?
Yeah, sure. I guess we can take Doris's question. Did you put it in the chat?
No, not yet. Doris, can you try to unmute? We still cannot hear you.
Doris, I think try checking your audio settings تحت, and under your microphone, check that you have the right one selected. Near the mute thing, just click on the arrow وشوفي select the microphone.
Okay, hello. Yes, you're right.
يلا مشي الحال.
Okay, great. I'm grateful for what you have shared with us. Mainly for Aquavolt, I already worked with financial advisors. So they used, unfortunately, for the cash flow and the DCF valuation on top of the income statement tool, OPEX. So what do you suggest if you want to redo the financial?
هلا انت انه اللي فهمته منك في financials.
Yes, it's done.
Most startups don't have a balance sheet or an income statement yet.
It's a projection, assumptions.
طيب, let's have a call offline and talk more in detail. And it might get a bit like a private details that you're going to want to explain to me. No, it's not going to be a 1 + 1 = 2 kind of discussion.
Yes.
So reach out to me, please, ونعمل قعدة مطولة.
إن شاء الله. Thank you كتير. Thank you.
Okay, great. طيب, هلا فؤاد, please go ahead.
Hi guys. Can you see my screen by any chance?
Yeah.
Perfect. All right, thank you, Hani. It's a pleasure being on the call. And to be honest, I think you guys have learned a lot from Hani. It was spot on. Everything he explained is basically what I've experienced during the safe round. And it all falls down to the founder himself and the confidence and being able to understand your numbers is the most important thing. So I'll give you a small brief about the safe, but before that, let me just tell you a bit about myself because I think it will help understand how I was able to close the round. So I come from a business finance background. I have more than 17 years of experience. I've worked with big companies, small companies, and startups. And to be honest, once you get into the startup scene, you just won't be able to go back to the corporate world. It's completely different. There's more energy in it. It's funner. It's much nicer than any corporate work. My first real startup experience was at Augustus Media. That was about 10 years ago. I'm not sure if most of you might have heard some of their brands. There's Love in Dubai, Love in Beirut. They're very popular on social media. So when I joined them, it was a very early stage, probably the same stage many of you are. So they had an early MVP, but no revenue, but the founder was very ambitious. 6 years down the line, working with them, I became the CFO of the company. And we escalated the business very, very fast. It grew very fast. It was successful in the region. Less than 2 years ago, I stepped down from that role and I started my own thing. I worked as fractional CFO, part of iPark, and I was a mentor at iPark, and I became a fractional CFO for several startups. I think I onboarded close to 30 at that time. And what I kept seeing every single time was the same story. Smart founders, they had the clear vision, they had the real hustle, but the business side just wasn't there. They didn't have any financial visibility. They had no structure. They made decisions based on gut feeling because nobody had the right numbers in front of them. And even if they did have the right numbers, they weren't really understanding how to translate it to decisions. The bigger the companies got, the more painful and expensive those became. And to be honest, after seeing it so many times, I realized that it was something that needed to be fixed, not a problem that is just something that can go away. And that's where I came up with the idea of ledgers. I can explain ledgers later. For the sake of time, I'll just talk about how I reached to the safe agreement and what the terms were. But the fact that I found the problem, the core problem, is the essential reason what helped me to build my confidence and helped me to understand what I needed to do to be able to achieve that. I'll walk you through how I managed to talk to my investors, and it became less of a pitch, and it became more of a conversation because it was a problem I believed needed to be solved. All right, so I'll start with. All right, so let me show you how this actually started. Now, the idea started back in October, just a couple of months ago. But I had this idea in my head since 2017. But back then, I didn't see a way to make it happen. I didn't see a way to make it real. What changed was AI. For the first time, the technology that actually caught up with the idea that I had. I think I was ahead of my time at that time, but because of AI, it linked everything that I needed to do to bring it to life. And once I started working on it again, it became very clear and very quickly. It was not a small problem. It was about something founders deal with every single day, staying in control of their businesses as they grow. At some point, you just think, okay, this needs to exist. So that was a couple of months ago in October. And after that stage, I had to make it visible. So once I knew the problem was real, I needed to make it visible. And I started exactly where most of you started, most of you are already doing it through this incubator. I started with Canva, and I just trying to get all my thoughts out of my head into a document. Then I moved from Canva after I got it set up to Figma. I built something more structured, looked more like an app, and it had a user flow. So I embedded the UX in it so that I was able to show it when I had to present it. By mid-November, I had something I could actually show. Not a finished product, obviously, it's a prototype, but it was enough to start our conversations with investors. Because once you can show something, usually, plus the founder's confidence and the belief in it, you can have a whole conversation without a revenue, without anything. And then I had to do a short validation. I wanted to make sure that the product worked and the product was needed. I spoke to a VC, a close friend of mine who was part of the AUB iPark, and he was the reason why I ended up joining AUB iPark. But I spoke to him not to raise. I already knew that VCs don't raise at our stage. That's why we work with safes. I just wanted validation. So I asked questions. Does this make sense? Is this a real problem? Is this something that could become investable one day? The meeting was very honest, one of the most important meetings I've ever had, because the first thing I raised was not money. It was confirmation that I was on the right track. So I found the problem that I needed to do. And that created a direction. In the end of the past year, I was able to walk away with clarity. So I had to now structure to build my MVP. And the VC himself actually gave me a very good advice to start with friends and family. Then go back to him and talk about valuations and pre-seed round. Simple as that. And once I had that direction, things started to move really fast. And before any money moved in, I was able to make sure that the problem was real and it was visible and the path was clear. As soon as you have the clear path of what you want to do and you're confident about it, things become much easier. I'll move on to the next slide. All right, so this is where this all started in January 1st. I had to the first thing I did was bring in the right people. The first real move I made was bring in Andrew, who's with us here. Hello. He's my CTO and co-founder, and he's a tech. They can't see you, don't worry. Well, I was while he was working on the business, on the technical side, trying to change my constantly changing Figma's designs into real life. I was working on the business side. He can complain about me later on. But I think one of the first things founders need to do once they get clarity is move fast and get the right people around them to start building. Because an idea with the right team behind it starts feeling very different to investors. Hani explained it very well. You can't have two CEOs sometimes in the same room. They create conflict. You need to have a founder that's leading, and you need to have the vision from the founder and the team around them to help him build. And as he said, one of the rounds that because they didn't have a CTO, they ended up losing 20% of their equity. That's very important to know. So I moved to the planning section. I needed to now start my roadmap. At that time, I was working on the business side of things and keeping the momentum going. So just like this program is, I started with my financial projections. Who am I supposed to hire? What cost structure do I need? How much money do I need for the first year? And how many people would I need to build this? My structure was simple. It was UAE, US based, and you've got a back office in Lebanon. That's the structure I had. And this next stage is to look at how to grow it. My 1 year financial plan turned to a 4 year plan. And it's very important to have a plan longer than 1 year because it helps you understand how you're growing, when to ask for the next rounds, when do you need cash injections again, and what is the team behind the entire force that's going to help you reach that goal. And once I figured out my first year's cost, which was around $250,000, it wasn't a random number. It came directly from what the business actually needed. Investor can tell the difference between a number someone picked and a number that came from real planning. And that's when I started my rounds. Once I had the concept ready, I had the prototype, I had my financial planning, I put together a pitch deck. This is the same structure that AUB iPark's following at the moment. And look, your deck needs to tell a story. It should not feel generic. It needs to show people how things are taking shape in your head. Then I started approaching friends, clients that I've worked with, and people I knew. But I was very selective at that point. I did not pitch everyone. I approached around 15 people, and 9 ended up investing. And I wanted to say something important here because I know some of you might be going through this right now. Do not let a few no's shake you. We'll always have no's. People won't understand your vision. But as long as you're clear about what you're doing and you're clear about what you're building, things can change. So at this stage, nobody invested at the moment because they're not investing they're not seeing revenue, they're not seeing any traction. In my case, there was no live product. Until now, we don't have a live product. They're investing in me. They're investing that I have a problem that I'm trying to solve. And whether they believe you can actually pull this off, they need to make sure that they believe what you're doing is real. Once you genuinely believe your product can become something big, not just useful, but big, that comes through when you talk. They can sense this. It ends up, it's not, you won't be trying to convince people anymore. You start just showing them something clearly and inviting the right ones to be part of it. So once you believe in everything you're doing, it's no longer a pitch. It becomes a conversation. And if they want to be part of it, they can be part of it. And if they don't want to be part of it, you're going to move on without them. And that's the confidence you need. Because if you believe in your product so well, then 10 no's and 1 yes, and you'll keep getting the yeses later. And this is basically, in a nutshell, how I was able to close the 250K round. With no product, what I've done is I've created investor confidence, which Hani spoke about clearly. It's the founder premium. Now, the hardest part of any round is always the beginning. It's the first investor is the toughest because nobody wants to be the first. But once a few serious people come in, it changes the dynamic. What also helps was keeping people updated, which Arthur pointed out the last call, where you have to keep sharing with the investors or potential investors that you're talking to, things that you're doing, things that you're planning. So I've shared things like I'll be joining the AUB iPark. I pitched for STEP conference in Dubai. We've applied for N5 in Dubai. And these things kept things working because they see that you're working, you have a momentum. By the end of January, we landed AUB iPark. We were at STEP, invited to STEP, and we were also selected part of STEP after pitching several times with them as part of the 30 spotlight startups in STEP out of 500 startups. And N5 Dubai was accepted us as part of their ecosystem. And once the investors saw this entire thing come to life, they joined as fast as they could. My plan originally was, and I'll be honest with you, is to gain the investment before STEP, at STEP actually. And I included the investors that this is the plan. If I don't get the investment before STEP, the plan is to get an investor from STEP. And that created more traction because the time before I left to STEP, all the investors called me up, we're investing. We don't want to lose this opportunity because they saw all these stages and momentum happening, plus the confidence, and they saw things happening in front of their eyes. So they had to get on board. And that built trust, obviously, and it built confidence that the plan that I've presented to them in January is coming to life. I've only prepared 3 slides, so this is the last slide, and I'll just talk about the safe and how I structured the safe. So once the investors wanted to come in, the next question became, how do I structure this properly? Safe is not really a common thing in our region. Now, VCs understand it, but individuals don't understand it. It's more of an American US terminology because they use a lot of startups. A lot of startups open there with friends and family rounds. It's not very common in Lebanon or in this region, but I had to explain it to them. And once they understood that it's a future equity, it became much easier. The safe itself is better for investors to join early because it protects them. And this is where I wanted to make this useful for all of you. As founders, because choosing a safe is not just about taking the easiest documents. As Hani said, there's a lot of documentation on valuation, on priced round, but this saves you on documentation. All you need is a 2 to 3 page document which explains clearly how these investors will convert into equity in the later stage. At our current stage, a safe made the most sense where I was. We were too early for a priced equity round. There was no live product yet. There was no revenue. There was no reason to overcomplicate the process with a full investment round. What we needed was something simple, efficient, and founder-friendly, enough to tell early believers to come in without turning the process into a legal exercise. That's one of the first lessons I'd give founders here. Choose a structure that matches your stage. We're all probably in very similar stages, the fact that we're joining the AUB validation stage. So I would recommend a safe structure if you're raising capital at the moment. In my case as well, a safe gave investors a way to come in early and gave me the room to stay focused on execution. Because as soon as you have the cash in, it's no longer chasing money. It's now you've got the cash in your bank. Now you just need to start execution. Makes life much easier. All right. Second question was the valuation part. What cap do I need to give? I set the safe at $2.5 million post-money cap. Now, for founders here, this is important. Your cap should not be random, and it should not be based on ego. I could have thrown a 5-10 million cap, but it won't fit right with investors. The number had to work in many levels, and I'll explain how I came up with that number. First, it had to feel fair. It needed to be attractive enough for early investors to feel they were being rewarded for taking the risk. Because at the end of the day, their risk is investing in you and the belief that you will take that product live. Second, it translated to something very clear. We required $250,000 for the year one. And on 2.5 million post-money cap, that means it's 10% of the business. So it was very clean, it was very simple, and it was easy to understand. And third part was, it was in the valuation range for early stage SaaS fintech model. So when you go do a research, check what model your business is, and then you'll see a range of where you could fall under, what kind of valuation cap you should fall under. So this number was not random at all. It was a mix of fairness, it was a mix of ownership logic and marketing position. And that's how I think founders should approach valuation too. Not by asking what is the highest number I can push, but by asking what number makes sense for the round, for the investor, and the business model. And now we move to on top of the cap, as Hani said, there's also a discount. I've offered 20% discount. Why is this important? Because founders should understand why a discount exists. The discount is there to reward early investors. That's what it is. In simple terms, if the next round, which is the price round, which we will have, goes below the cap. So if a VC comes to me and says, your valuation is at 2 million. So what happens then? You protect your investors that came in under the safe, because there they will get 20% discounted from that 2 million. So they will get a better rate than what the VC would have given.
Hey, there on the AUBX Sprint 4, there are details on how that calculation works, so you can check it out too.
So the way you need to think about it, and there's a way you need to explain it to your investors, is that the cap protects them if your valuation comes higher than from that, and the discount protects them if the valuation, the price round comes below that. So it protects the investors on both sides, and that's how they feel safe and secure to be investing with you. All right. And finally, the money had a very clear purpose, and that's why it made it more clear. It was not raising money just because I could. I was raising money against a plan. The $250,000 was meant to fund year one, to get the first hire, the first team, build the product, and set the US with an operator. And this is a big part of why investors were comfortable. It was also the founder. It had many factors. You've got the founder premium, and you have the understanding of the business, and you had a clear plan of what you needed, and the numbers made sense to them. Raising money tied to plan, tied to a milestone, or tied to any capital is funding much faster. I've shown you guys how long it took from the day I started raising capital to the day I raised. Within 3 weeks, I was able to raise $250,000. It didn't take me months, it didn't take me years. It took me 3 weeks because there was a structured plan. There was founder premium confidence from investors, and there was momentum. I was able to tackle all the plans I had sent them. And finally, there was always investment in communications with my investors, potential investors. They weren't investors at that time. Every 2 weeks, I would send an investor email, and that helps keep them on the loop. It helps them to see the updates come to life. And the faster you create momentum and the faster you deliver on these things at the start, the faster you build confidence and trust between you and the investors. I can take questions if anyone wants to ask any questions. If anything wasn't clear, please go ahead and ask.
Yes, please go ahead. No need to raise your hand. Hi. Okay. Thank you for the presentation.
Thank you, Hani.
Hi. So we're at the end of this. Do we have a question? No? Okay. So we're at the end of this. Thank you for joining. Hope everyone is safe. Very important that you understand how safes work. Check out the AUBX module Sprint 4, Entrepreneurship Foundations. Watch this webinar again. And if you still have more doubts, we're more than happy. If Fuad come in, he's more than happy to jump on a call and discuss these technicalities. And we will help you through them. So stay safe, and thanks for joining. Take care, everyone.
Thank you.
Thank you.